The dot-com boom, also known as the Internet bubble, was a period of rapid growth in the usage and adoption of the Internet in the late 1990s, particularly in the United States. During this time, many Internet-based companies, or dot-coms, were founded, and their stock prices skyrocketed as investors poured money into them. During the dot-com boom, the Internet was still a relatively new technology, and there was a lot of excitement and hype surrounding it. People believed that it had the potential to revolutionize the way we communicate, do business, and access information. This led to a rush of investment in Internet-based companies, many of which were started by entrepreneurs with little or no business experience. These companies were able to raise vast sums of money through venture capital and IPOs, and their stock prices soared. However, many of these companies were not actually making any money and were relying on the expectation of future profits to justify their high valuations. When it became clear that many of these dot-coms were not going to be able to turn a profit, the bubble burst and the stock prices of these companies crashed. This caused a lot of investors to lose money and contributed to the economic downturn that followed. Despite the crash, the dot-com boom had a lasting impact on the Internet and paved the way for many of the online companies and services that we use today. The dot-com bubble and the crash that followed had several negative implications, both for the economy and for individual investors. One negative implication was the economic recession that followed the crash. The dot-com bubble was a contributing factor to the economic downturn that occurred in the early 2000s, which was characterized by declining economic growth, high unemployment, and declining stock prices. The recession had a ripple effect on the global economy and had a lasting impact on the financial markets. Another negative implication was the loss of wealth for individual investors. Many people invested in dot-com companies during the bubble and saw the value of their investments skyrocket. However, when the bubble burst and the stock prices of these companies crashed, many investors lost a significant amount of money. This was especially true for those who invested in these companies at the peak of the bubble and were holding on to their investments when the crash occurred. Additionally, the dot-com bubble and crash had a negative impact on the technology sector and the overall confidence in the stock market. Many people lost faith in the market and were hesitant to invest in the wake of the crash. This contributed to a broader decline in the stock market and made it difficult for companies to secure funding through IPOs and venture capital. There are several steps that can be taken to try to avoid a repeat of the dot-com bubble and the economic downturn that followed. Regulate the stock market. One way to try to prevent bubbles from forming is to implement stricter regulations on the stock market. This can help to ensure that companies are accurately valued and that investors have access to accurate and complete information about the companies they are investing in. Educate investors. Another way to prevent bubbles from forming is to educate investors about the risks of investing in improving companies and the importance of diversifying their investments. This can help to reduce the risk of individuals losing large amounts of money if a bubble were to form and burst. Encourage long-term thinking. Encouraging investors to focus on the long term rather than short-term gains can also help to prevent bubbles from forming. This can involve measures such as incentivizing long-term investment or increasing the length of time that investors are required to hold onto their investments. Monitor the economy. Regularly monitoring the economy and identifying potential warning signs of a bubble can also be helpful in avoiding a repeat of the dot-com crash. This can involve keeping track of key economic indicators such as GDP, unemployment, and inflation, and taking action to address any potential issues that are identified. It is difficult to predict whether or not another dot-com bubble will occur in the future. The dot-com bubble was a result of a combination of factors, including rapid technological advancement, hype and excitement surrounding the potential of the Internet, and a lack of regulation in the stock market. While it is possible that some or all of these factors could come into play again in the future, it is also possible that changes in the way the market operates or in economic conditions could prevent a similar bubble from forming. It is important for investors to be aware of the risks involved in investing in improving companies and to exercise caution when considering such investments. It is also important for regulators to monitor the market and ensure that it is operating fairly and efficiently.